Welcome back as we continue this debate on PMS versus MF. In the previous part, we spoke about investment behavior, fund manager behavior, and the processes that are followed between both PMS and MF. In this part, we will speak in detail about tax efficiency, product investor fit, and how you can maybe come to a conclusion of this debate between PMS and MF. So without further ado, let's get to it. So the next question, Sam, is now investors are very well aware of where their portfolio stands, right? They are very informed about what kind of returns they're expecting and what kind of returns they actually make, which gives them more scope to compare it with several other products that are available to them. Let's say, for example, a mutual fund. How well do you think a mutual fund compares to a PMS? Is that the right benchmark, if I may ask?
I think, investors will compare whatever it's convenient to compare against, right? So, and we've seen this in every cycle. Sometimes they will compare against the benchmark index and say that, this product is not performing. And that creates like a pressure to do short-term performance or benchmark hugging, which is something that we avoid completely, right? You need to play your own game as a fund manager, whether you're managing a mutual fund or whether you're managing a PMS. I think you need to really have your own mandate and focus on that and think a little bit long term, because that's where you can really create wealth. If you're going to chase quarter on quarter, you're just going to do what the benchmark does. And then you're pretty much saying that there's no value addition that an active fund manager can give you. So this tendency to hug and chase the benchmark needs to change, and there is a lot of value addition that you can do. And if you have a year of drawdowns and negative returns, then there's an automatic investor mentality shift where they think that, if I had put this money in an FD, I would have done better than what I've got now. So comparison will always happen and it will never really be in favor of the product. I think you can look at MF versus PMS performance, because as long as you're keeping some broad categories in mind, right? Like you cannot take a small and mid cap product and benchmark it against a large cap product and then try to see, what is the difference in performance or difference in drawdown. You need to maintain some character integrity, meaning there has to be some level of apples to apples comparison, because that's when it makes sense. And you also, I think, want to be careful about things like churn, because sometimes a churn strategy would work very well in a mutual fund product because the investor doesn't have the tax impact, but it may really create less value for somebody who's paying those taxes, right? So the style of investing also matters, and the product allows you to do certain things which something else may not.
Fair. Which brings me to expectations. How do you think investor expectations differ between a PMS and an MF?
I think when it comes to PMS, obviously, unless you're looking at a much more conservative strategy than what mutual funds can offer you, you are looking to make a little bit more return than what a mutual fund can give you. The basic idea being that, even if you have no other expectations, the tax impact is on you. So at least adjusting for taxes, you should be making more. So people typically view PMS as a more aggressive strategy. And I think the SIF has also been a response to that, because there is a demand for more exotic or more customized kind of investment solutions, but not at the ticket size of 50 lakhs and above. So keeping that in mind, I think there is always an expectation that returns will be more in a PMS. But the nature of equity is such that you're not going to have positive returns every year. Even if the return expectation is 12% compounded, I think a lot of people think that means year on year I'll make 12%. They don't realize that you can have a year in between which is flat, you can have a year which is negative, and then you can have a year where results make up for average to mediocre to bad years, right? So returns can be lumpy in nature, so point-to-point comparisons really don't make that much sense. From an expectation perspective, I think more important would be to sort of look at how you can grow your wealth in both of these products over the long run, and finding the product investor fit that suits you is the biggest sort of wealth creator that you can have.
Right. Even if they're able to find that right product investor fit, there's one thing that's constantly bothering them, which is taxation. I feel like every investor today is very on top of how much should I pay, how much will I have left after I pay those taxes, right? Can we speak a little bit more in detail about which one is more tax efficient and why they should look at that option?
So when it comes to tax efficiency, I think mutual funds have a clear advantage because within the portfolio, any transactions are not taxed at the investor's hands. So if you want to be more tax efficient, or if you are more tax conscious as an investor, you want to look for a product that doesn't churn, right? So that is a ratio that you want to measure. That is a ratio you want to ask the fund manager about. You want to understand their strategy. If you're on the low tax side or you're not particularly bothered about taxes, then it doesn't matter whether your fund manager is churning the portfolio or not. At the end of the day, if you are in the right product with a low churn and which has a very good process in terms of being able to identify ideas as well as give you that alpha, then I think your post-tax returns can still be higher than what a mutual fund gives you. So tax cannot be the only deciding factor. I think one of the things that I brought up earlier is the fact that there is an asset liability mismatch, right? Which means mutual funds tend to own a set of stocks which they believe can be more liquid or where price discovery is easier, or they tend to hug the benchmark so that they don't lag in performance. So this is where I think a lot of value addition can come in, and we shouldn't look at tax as the deciding factor anyway, because tomorrow if they change mutual fund taxation, then what does that mean for an investor? And in different parts of the world, mutual funds are taxed differently. So for example, in the US, what the fund manager churns within the mutual fund portfolio is actually taxed at the hands of the investor. So whether you sell or not doesn't matter. What your fund manager does matters. So I don't think that should be the deciding factor. It can be one of the things that you consider, definitely.
I think we've spoken at length about the major technicalities between a PMS and an MF, this ongoing debate that never seems to end. But I have one fun last question for you. If an investor came to you with 1 crore and said you can invest it as you like between PMS, MF, AIF, what would you do? What would your suggestion or recommendation be?
So this is like a disclosure, of course. Like I started my Sphere account earlier this year and I do have a PMS, but prior to that I was running a mutual fund portfolio and I did not liquidate my mutual fund portfolio to come into the PMS. It's been two separate things. I still continue my SIPs, I still top up my mutual fund portfolio because I do see value in both sides. There are different things that you can achieve here. And I think mutual funds are a great way for you to create wealth over a period of time without you really putting in too much effort into it, right? Meaning your SIPs are just going every month. And over a period of time, you realize that it's very easy to save 10, 25, 50 lakhs as long as you're consistent. And that is something that I've learned. So I don't want to give that up. And it's been great. Like I think I've had a flavor of asset allocation. I've had a lot more peace of mind. And I think when you're saving, especially as a young person, you don't necessarily have financial goals in mind, right? You're just saving. And this is a great way to do that because I don't have to think about why I'm doing it. And I think for someone who's coming in with 1 crore, it really depends on what you want to achieve, right? So for some people, it might make sense to do only PMS. For some people, it makes sense to do a combination of both. And like I said in the beginning, what I'm noticing more and more with investors today is especially those who've experienced mutual funds for 4-5 years, they're quite happy with the product. They're not really looking at PMS as some sort of upgrade, which was what we saw in the market a few years back, where the goal was, oh, let me get to 50 lakhs so that I can put my money in a PMS. I think people are seeing the merit of owning a portfolio management service, right? Because they understand that, okay, there is some value addition. This is what I'm getting in return. I can be a little bit more aggressive with my return expectations. I do get to participate and structure my portfolio through participation. And I think that is the most important thing, right? As long as you are happy with the products that you choose and you're able to scale up on both sides, That's the most important thing. So if you're confused, then of course the simple answer would be just do 50-50. But if you have more of a strategic vision, then I think you can contribute more to PMS depending on what you want to achieve.
Right. Two key takeaways: right asset allocation and peace of mind. That's the dream combination that any investor needs to look at. Thank you so much, Sam, for doing this with us today.
Thank you.
We hope you've had some really insightful takeaways from this. Stay tuned as we bring more such videos to you.